Today's market call is presented by Robinhood. Elevate your trading with Robinhood Legend, the sleek, free, customizable desktop platform built for active traders. While there is no cost to use the Legend platform, there are other fees associated with your brokerage account. See the Robinhood Financial Fee Schedule for more information. 7 a.m. on the East Coast for this market call. The calendar has flipped to the month of September. By the way, that would be letter U. Dan mentioned the other day that I haven't done that in a while in the futures world. September is the letter U. Then we go to the month of October, which is the letter V as in victory. However, as I have mentioned, the old timers on the floor of the Mercantile Exchange would actually write the V upside down, because U's and V's would look eerily similar in their haste to be quick. Hello, Dan. Oh, by the way, Braxton Worth will be joining us on this Tuesday. How are you, Dan?
And you know who's going to be joining us tomorrow?
Amanda Diaz.
Amanda Diaz is back, people. Just like, let's get in the chat.
Amanda Diaz.
We know that she's creeping right now. Let's be honest. She knows.
Hello, Amanda.
A little bit of a buildup for her triumphant return. Guy, we got a market that's down. Rarely in the last few months have we turned on our mics at 11 a.m. for market call and say the market, it's feeling a little jittery here, down 1.25% ish for the NASDAQ, 1.1% for the S&P. CC coming in on our, I guess it was a Monday night newsletter guy. He had the S&P going 1.2% either direction for a 4-day week, 1.7% for the NASDAQ. When you think about what we have going on between now and Friday morning, the all-important August jobs report. We have a few earnings this week. We got lots of headlines. I mean, a lot of weird stuff going on. Yeah. I'm on the socials here, Guy.
I thought you said you were back. A week ago you said
2 days.
You made this announcement. You said, after much thought and consternation, I've decided that I'm going to come back on the off.
So, Jacob, pull up our Twitter here. This was the Twitter that I launched in 2011, At Risk Reversal. We've been around a long time, guys. The At Risk Reversal. And I went back on for 2 days. I put my little picture up there. I changed the name. And you know what? It just sucks. Like there's just, you know what? You just waste your time like watching all this crap down there. This Carter Braxton Worth. So we're back. It's Risk Reversal. You're never gonna have to bother, to see me.
I know him. That's Vincent Daniel.
That is Vincent Daniel. All right. Let's talk about. So we do have some earnings this week. I think that we have Salesforce. You and I talked about Salesforce last week, and really why you and I both think it's important just to get a vibe on where the state of software is in this oncoming AI agentic world. So we know that Mark Benioff is going to tell a big story. We'll talk about more of that tomorrow. We also have Lulu. It'll be interesting to see with some of this, some of the stuff about this appeals court or federal court knocking down the tariffs, Guy, that's going to go to the Supreme Court. Some of these consumer products companies, discretionary like Lulu, they report. Oh, you're just giggling. They report this week. It'll be interesting to see what they have to say about that. We had ISM this morning, manufacturing.
No good. No bueno.
Consecutive one. So where do you want to start here?
All right. First I want to start with this. This is from Jacob. Dan's Twitter tenure lasted as long as that Cracker Barrel logo. That's very funny. I mean, that's very funny.
I will. Let me just put a bow on that conversation. So I don't have Instagram. I don't have LinkedIn. I don't have TikTok. I don't have Snapchat. I've had Twitter for a long time. Twitter was a very useful tool for us. I used to curate a lot of news. I used to follow a lot of people I thought was interesting. A whole thing devolved. There's a lot of performative bullshit on there. I just don't have time for it. I went back on. I thought I'd check it out. It's a waste of time. I'm out. I dropped the mic.
You're 5,000.
Audi 5,000.
So that you put a nice bow on it. It's a nice bow.
Thank you.
So before we get into the granular stuff, historically, and when I say historically, since we've been doing fast money, it seems to me, and I'm sure like some Grok or whatever AI bot can tell you immediately, but these 3-day weekends, typically the market comes back, and for whatever reason, you have this levitation into that Monday night into Tuesday. Obviously, that didn't take place. I'll mention this as well. Friday was month end, I think, as we know. And historically, again, in the context of as long as we've been doing the show, they usually ramp things up in the month end. That didn't happen either. So there have been a number of strange occurrences. I will tell you, and we'll get into this. Global bond yields continue to be a problem, but specifically the things that you mentioned. Lululemon, high specialty retailer. There's been zero bounce in this stock whatsoever. I think the recent low, I believe, was 186 or so, and I think that happened maybe a month or so ago to the day, maybe in early August, but you get my drift. No bounce whatsoever. This is a stock that top ticked, I want to say, you probably have it in front of you, December of last year. No, December of 23, excuse me. North of $500, you see where we are now. What we have said 100 times is specialty retail is great on the way up, but once competition comes, you can't get in the way, and that's been true. In terms of Salesforce, and I do still hold out some hope. I think the stock is trading, what, Dan, like 250-ish or so. We have pointed out that this 235 level, these double bottoms, one from, I want to say, April of this year, and again, we made it in early August. That's a big level, and we did bounce off it, but obviously, with the way the broader market is trading, I think people are going to walk with some trepidation. I still think that Salesforce can surprise to the upside, but 235 is your bogey on the downside.
Yeah, I mean, that to me, and we could draw the line, I think we did last week. You see that 200-day moving average. You go through there, man, and it's just like that means the story as it relates to generative AI, just the street's not buying it, right? And if anything, they see them being disrupted. So we'll see what they have to say. We know Benioff is going to be, like I said before, he's going to be pretty optimistic. I think we have Carter Braxton Worth waiting in the wings. I don't think for any reason we should keep him waiting any longer. There he is.
Hi guys, how are you?
Carter and I have very similar
back
shirts.
To school or back to something or end to something.
How Carter, you still have 4 school-aged children.
I do.
Is this a busy kind of week for you, huh? Like getting them all back in there?
It's like I remember getting back to school for myself. It's obviously preseason for sports, and then there's the school part, and then I have some strong students, some less strong students. It's it's
name names, Carter. Name names.
All good.
No, don't. You don't want to dox your children. I have some strong students. I have some weak students.
Listen, Guy, you know this. The A students had to work for the C students. This is a documented fact. So I'm encouraged.
Yeah,
hey,
look,
so
as you should
just
be.
Just a little note. Carter Braxton Worth is going to be with us at the Robinhood Legend Summit. That's going to be next week. I think you'd stream a lot of it if you're not going to be there, but it's going to be on September 9th and 10th in Vegas. We got Danny Moses. We got Vincent Daniel. We got Porter Collins. These are all Carter's old friends too. I love the fact that maybe next week on a podcast that we do from out there, we'll talk a little bit about how you guys all know each other, the Sea Wolf and the guys from back in the
20
day.
years.
So Carter, we started this and we're just going to wing it here because like when you walk in on a day like today, you just heard guys say that, we had month end, right? We're going into quarter end at the end of this month. If you think about this week, we have some data, we have some earnings, we have a whole bunch of headlines. Maybe we'll talk a little bit about yields. Guys been talking about the 30 years that have been going higher all over the world here. And, there's been some equity market palpitations in around that. We know at the end of the week, we have the jobs report already. Expectations are pretty low. We came in at that revised, 73,000 from last quarter or last month, and they revised the other ones. Here, the expectations are about flat, except that you see the unemployment rate going higher, 4.3%. What, from a macro standpoint, what sticks out to you? What are you most focused on as we get into them? We're going to have CPI, PPI, and the Fed meeting.
I mean, if you think about it, there's no one theme that's necessarily intact or coherent. Let's say commodities. We could say, look at copper could just collapse, one of its biggest weekly drops on record. Gold is surging, silver is surging, oil's doing nothing. Grains are at multi-decade lows. So is there commodity inflation? Not really, but certain commodities are doing very, very well. Or the notion of higher rates, the 10-year yield is still stuck in this Goldilocks, call it 4.5%, 4% forever, whereas 30 years kind of inching up and so forth and so on. And it's that way with the the bifurcation in the stock market, right? That's not necessarily a coherent theme. You've got many areas that aren't performing well, and the concentration, but that's been a story that's long in the teeth. So, but the most important thing one could say is that seasonality. Is September a bad month? It is, but if you look at the stats, it's not a big bad month in terms of on average down a little bit. There is no, it really always does get back to, of course, trying, and this is what alpha's about. It's what the greatest net worths that have been created in the market are about. It's about picks, right? It's trying to find an area theme, whether it's individual stock or a sector or a commodity or a currency, where one can prosper and hopefully with some leverage, really prosper.
Now, Carter's been spot on in terms of the bond market not being a story, and I want to be crystal clear. He's also mentioned the fact that you woke up today, bond yields are probably where they were a year ago, and so on and so forth. And he has been right to point that out, Dan. But what I want you to pull up is the TLT chart, and if Carter can just opine quickly. I look at this, and the TLT started to drop precipitously from, I don't know, let's call it 2020 down into the middle of 2023. And ever since that October low, about 83 and a quarter or so, yes, the TLT has bounced. Yes, yields have come in, a couple different times, but you're sitting here with the TLT at 85 and three quarters or thereabouts. And, I look at this and say, there's really been no meaningful bounce in quite some time. So obviously one of two things is going to take place here, Carter. This is what I think happens. I think we're just sort of trading around these levels, are going to take the next leg down. Now, it could also turn into a bearish to bullish reversal. My question to you is simply this. Where do you think we need to get above in the TLT in order for that sort of bearish to bullish reversal to come to fruition?
Right. So it was a very much and profitable bearish that failed, right? So once the 150 days turned and so forth, and you see all that in 2024, but it crapped out, as the expression goes, which means after being set up well and yielding as a trade, it's all fallen apart. Can it ultimately make the turn again, so to speak, which is to say, rise with rates going down? That's as good a bet, I suppose, as that it breaks down here and yields spike. But I think, the one thing that where one can have their cake and eat it too, is that if this really is going to make new lows, then by all accounts, one is comfortable maintaining, and has right to always maintain, hedges in the equity market, either outright shorts or hedges that capture downside risk if and as yields are actually going higher. We shall see. But my hunch is that it never does either one. And it's 3 years ago. So you can do one of these AI searches for the expression higher for longer. Mm-hmm. And you can track exactly its frequency of use. TV, printed reports, Wall Street analyst reports, and so forth, quarterly calls. And it peaked, of course, when rates peaked. And then it kept going, but rates went down. And now there aren't any references. You can sit quietly and you won't hear the expression. It's when it gets too cute, like Mag 7 or all that kind of thing, higher for longer, or expressions, bold expressions, uninvestable. China's uninvestable. These kinds of things. It's always ready to tack the other way.
Look, you make a fair point. That's a treasury yield, so that's obviously the inverse of what we showed you with the TLT. Let's go to gold, Carter, because you brought a gold chart as well. And again, I think we've been somewhat steadfast here over the last couple months. What we have said, I think, pretty consistently is that gold's been going sideways, getting ready for the next leg higher. And today, at least, it appears as though that's what's taking place.
Right. So to some extent, inverse to the general equity market, which we know has been a problem in terms of where gold was in April. Gold spiked. That peak is April 22nd. That's essentially the stock market's low, April 7th, right? And from that peak, which we're just now, gold's perhaps the single worst performing asset there is. How many things are unchanged since the middle of April? Every stock is up. Some are up 100%, 200%, right? Whether it's Palantir, what have you. So it's ever thus the flow of money, the risk off or the defensive thing doing so well, spiking in April as equities are plunging. And then it's been the worst performer since April. And just now, it's back to where it was on April 22. So here we are, September 1, basically 5 months later. That's what a breakout is. And I think one plays it. Of course, miners have been off to the races. They're too steep. I think you fade the miners here.
Guy, you've been calling for this move, as we talked about. I think Carter made a great point about that kind of April low in the S&P, the high, right, that we saw in gold, and then a lot of sideways action. You saw this kind of attempt at 3,400 on numerous occasions, right? So here we are, we're breaking a fresh new one. And I guess maybe first, Carter, if you're like a measured move sort of person, is this what you're expecting on a breakout here? If you've been banging around between, let's call it 3,200 and 3,450, you get the breakout, you say you consolidate above these prior highs, is the whole trick that you're looking for this 200-300 point move in gold? Or how do you think about that if you are bullish?
There are endless ways, right? You can measure the width of the range. You can also, for a triangle, it's the from the peak of April to those lows around 3,000. Measured moves have some wiggle room to them, but certainly 3,600 would be a minimum, and then on from there. Remembering this, that of course, just now, April 22nd, we got back to the penny, to the 45-year high adjusted for inflation back in 1980-81. So gold adjusted for inflation is unch for half a century. One could say that means it's got a lot more to go.
You know, Carter mentioned the GDX, Dan. We're trading about 64 3/4. I think we made, well, I know we made a 52-week high. Not only that, if you go back and put up a chart, we just traded up to levels we saw 14 years ago. I'll go all the way back to 2011. And I think, you know, Carter's point about fading, well, here's your level. I mean, you can see it as clear as day on that chart. We're right back up to those levels. So this is sort of, and if you go back and look, and this is, I'm wrong all the frickin' time, trust me, but this is one that we said would trade back to the levels that we saw, you know, 14, 15 or so years ago. So here we are. So when Carter says you fade it here, and I don't want to speak for him, I don't think he's saying the move is entirely over, but I do think, you know, given where we are, given that level 14 years ago, this is a natural place to take a little money off the table, then look for lower levels to reload.
So Carter,
yeah, just steep. It's steep and uncredited. Interestingly, of course, let's say gold doesn't break out, and gold, this is a little bit of fake, maybe a double top, and starts to roll. That would surely be a signal that gold miners are extended. But in and of itself, it is not as it relates to gold. Yes, we're all very aware if the underlying commodity is surging, these highly levered businesses print money, right? Their earnings can double and triple in any rolling 6, 9, 12-month period. The chart is still the chart, and it is steep, uncorrected, farther above trend than at any point in the last 5 years, 10 years. And it's the kind of thing where there's nothing wrong with reducing exposure while staying long.
Yeah, and so just to my eye, and that doesn't mean a whole heck of a lot, but just kind of this breakout level at about 54 1/4. You see where we are. We're 64 3/4. You see your 150-day moving average. It's going to be at 52 in the not so distant future. You see that RSI just kind of off the chart there. Let's just kind of look at the options chain here for a second. If I want to just kind of look, I go at the money here on the legend. It brings me right to there just to get a sense of kind of where, let's just say the 64, but that's the weekly. Let's go out to, let's call it October 17th, because that's going to be regular way expiration in October, just to give you a sense of where things are. I mean, guy, 260 on a $64, that's the basically the at the money put or so. Let's just say you were going to look and do the 64, 54, you know, I mean, you're not going to sell that 54, but that's, you know, you're getting basically 2 1/4. That's not a bad risk reward if you think you can get this thing back towards 54 or so on a, you know, some sort of pullback. So some of the options we'll take a tighter look at some put spreads maybe, because that one seems like to maybe risk 2 to possibly make 8 over the next few months. If you have a pullback to that breakout level, that's something that could be interesting to me, Guy.
I think you got to listen. I think this is where that absolutely could be interesting. I think you want to formulate some sort of trade around these levels. This is, you know, this goes back to the things we talked about. I don't want to get too bogged down here, but you got to move your feet. When things get to levels that you thought they would get to, and, you know, we're talking about 14-year prior high. You got to do something here. I think it's just, it's not good form or not good practice, I think, to use a term Carter uses, just to sit here and continue to hope it's going to do its thing. You gotta either sell some upside calls, earn that premium, understanding that's not protection, maybe use that premium to buy put protection, sell a quarter, third, half your position, do something. Because if you don't, and this thing starts to sort of grind lower, you're gonna become paralyzed, because I've seen it 100 times before. So when you get to a place that you thought could happen, it's incumbent upon you to do something, Dan.
All right, Carter, maybe you can help us figure out what to do in the S&P 500. You brought some charts here. We've just had this, few day sort of sell off, or a couple days here, and just give us a sense of kind of what you're seeing. And, you see that uptrend right there. I think you're going to try to draw it a few different ways.
Yeah, I'm going to have this in reverse. Let's see. Can I just see all the charts? Sorry, I might have.
Sure. No, that's okay.
Let's see. There we go. Let's go that first one. Here we go. Okay. Back other way.
Back. Yeah. Move it.
There we go. The point of this exercise is that it's very subjective. Okay, you can draw the lines, and I try to, in every spoken word on the TV and in report, let's figure out together. These are gentle phrases. What my eye sees. That's me trying to say that, hey, there's no fixed answer. These are judgments. So what if we drew the line that way? It broke trend 2 months ago. Let's be a little more forgiving. Let's look at the next one. Okay, but that's another break in trend. Let's give it a little more wiggle room. How about this one? Next one. How about that one? How about next one? You can play this game all day. The point is, it's nothing so far. It's 2.3% from the high. The real question is really not about the trend line. Anyone can do that. I have school children that can draw these lines, just change the color. It is about a judgment. Is the market full? Right? Expensive, can't use that word. Things go from 10 times sales to 20 times sales, right? Things go, Western Union stocks trade a PE of 3. Ford can get to PEs of 4. Is that cheap? Those are bad words, cheap, expensive. What the word full means, in my thinking, as I learned it from older men in the business, and that's not to say there weren't women, but it was mostly men. I'm 60, so think back when I was 20, that's just the way it was, that it's a lot of money has been pushed into the equity market since the April low, a lot of time. April to May, May to June, June to July, July to August, now September. It's come a long way, 30, 40, 50% with certain stocks up 100 to a new high. Market's full. I think that's the expression. So where does it draw down to? Does it put in an epic top? We have an epic bear market down 70%. Maybe. Is it just a minor, another 2% dip, and we hold this line here? We never broke trend in the first place. All those other blue lines being wrong. Maybe. But I think one can say that it's, you hedge here. You take some money off. We know seasonally it's not a great period, the month of September anyway, and then go from there. So there is no answer to this other than, and that was I thought, achieve that by, and let's have some fun. Let's start the blue line again. And from the beginning, and let's have this clock hand go down. Fair? Let's do the next one. Fair? Next one. Fair? Next one. Fair? How about this one? Fair? Now, the ultimate thing is make that a horizontal line, and you connect the highs from February, which is to say it can go all the way down to the level from which it broke out, and it would still be a very healthy sort of, but we shall see. At the end of the day, it doesn't get down to this buy, sell, or do nothing, right? Hold is a weird euphemism on Wall Street. I would say it's a better time to reducing, to selling, to trimming than to adding, buying more, leveraging up. That would be it.
Yeah. Yep. And Guy, one of the biggest, days of volatility we've had since April was on that jobs report, I want to say about a month and change ago, or I guess a little more than a month ago. So again, it didn't take long to kind of fill in that gap and make new highs. All right, Carter Braxton Worth, we really appreciate you being here on a Tuesday morning. We'll see you in Vegas next week. We got a lot going on there at the Robinhood Summit. Really excited about that. Thanks so much. Guy, when you talk about judgments, you look at that SPY or the SPX chart. Last week we made a judgment, okay? And we made a judgment not exactly on technicals, not about drawing lines and that sort of thing. We took a look, and let me just pull up my legend here for a second here. And, listen, these charts, however you want to move them around, you know what I mean? Like you can make things, this looks, well, this is the trade from last week. Okay. So I just want to highlight that, right? So this was last Tuesday and we were looking at a 640, 610 put spread. It was $30 wide. We paid $5 for that, right? So you can make up to $25. The break even was down there at 635. You have losses at 640 and you have a max gain down at 610. Okay. So you see that. So we were primarily, let's go to my chart for a second, making a judgment on vol. Like we just thought with the market at all-time highs, and we were looking at all these events that were coming up in September, and we were saying to ourselves, options are too cheap. To have a near the money put spread that gives you that sort of width for a potential, hedge or an outright bearish bet, we just thought it looked too cheap. Now the timing could have been good. It could have been bad. Who knows in a day from now or so. But thoughts here, Guy, on where we have this thing, because 635 was kind of our breakdown, or excuse me, our break even, and we're kind of right there.
Yeah, I see. To me, and I think Carter sort of alluded to this, although his language was not as strong as what I'm about to say. I feels as though now you're starting to, in a period where you can step on the gas. Like it feels as though we got it right in terms of timing, in terms of direction, and now the market is starting to cooperate. And I want to be, again, crystal clear. I said a number of times in the month of August that I thought we would see a 25 print in the VIX by the end of August. Obviously, that didn't come to fruition, so I was wrong. I do think we're going to see a 25 VIX, though, relatively shortly, and today looks more likely. But your point about it was a vol play, I think, is exactly right. And given what's going on in the environment, in the world, and you talked about global yields, to me, the VIX is going to start to be the story in addition to things that we talked about. So, yes, I think that trade is alive, and I think that trade is well. And I think this is one that you can start to sort of step on the gas a little bit to the downside. I think if the market were to start moving lower, I think that movement lower is going to start to build on itself, I guess is what I'm trying to say.
Yeah, and so we were looking slightly out of the money, Guy. I mean, slightly out of the money. If you were to look at this, the 636, we're doing a 30 wide, and bring it all the way down to 606. Okay, so that gives you $30. Just to give you a sense, right now, that would cost you $6. So a week ago, you saw a $30 wide near the money that cost $5. Now it's costing $6. And then on a day like today, you're obviously seeing vol bump up a little bit. I just think that's a good exercise to kind of take a look at there. So again, later on this week is going to be the main event, Guy. What is like the earnings? Are we down to tag ends? It doesn't really matter. Or do you think that the investors should be paying attention to a couple of the ones that we highlighted?
No, I don't. Well, in terms of the broader market, I'm not necessarily like. I don't think you agree with this. I don't think Lululemon is market moving. I don't think necessarily Salesforce will be, although people will start to make some assumptions, I guess. But to me, what I think you really have to focus on this week, and something that obviously I've been talking about, blathering about, boring the shit out of people about, is this continued move higher in global yields, and it is happening right before our eyes. Now, people will explain the move in the 10-year today in the United States on the back that maybe we have to somehow pay back the tariff money we took in. And I can't speak to any of that stuff. I don't know what's happening on those fronts. But what I do know, and we had this conversation earlier today, the move in yields has been taking place longer than these, tariff paybacks have been discussed. And it's not necessarily in the United States, although I think that's coming to a theater near you. It's what's happening in Europe and in Japan. And I think that's going to continue to be somewhat problematic. And, we'll have some questions that we're going to get to, but, I think that's the main event this week. And look, obviously jobs is important. I think it's going to be a shitty number. I don't know how the market interprets that, though, to be honest with you. I mean, people will look at that and say, this gives the Fed ammunition, cushion, whatever, to be dovish, and they'll somehow construe that as bullish. But you mentioned the ISM earlier. That's not bullish. And regardless of what people say, I mean, an unemployment rate going higher, people losing jobs, an economy that's driven by people having jobs and buying stuff, by definition, is not bullish.
Yeah, no doubt. And the other thing we're going to start to see is just some of these federal workers. It just seems like the cuts just keep on coming, and so I think that that's probably one of the things that we saw those revisions about over the last few months or so. I want to go back to the legend here for a second, guy, because I think this chart is actually pretty telling. So we were talking about there was that big move down one day. This is Nvidia, okay, and we know that they reported what was it, Wednesday after the close, and so we've had this is now 4 consecutive down days, guy, and you can see one of the things about the charts. And one of the things I love about these charts is how quickly you can move the time periods here, right? And so you look at this thing and you look at it like this and you say to yourself, well, maybe it's just consolidating. Maybe it's a little flag here, right? And then if I kind of go like that, I was like, well, that's a pretty epic thing. You see these, sharp moves up, consolidation, sharp moves up, consolidation. The consolidation that we've seen over the last year, though, guy, is very different than the ones past because the volatility bands, how wide they have gotten. And then you look at yourself here and you say, like I just said, 4 consecutive down days. You see that 150-day moving average. And if I want to go here, and you guys know what I'm doing here, this kind of let's just call it 154, guy. That was the breakout level, right? The prior high that we had back in January. You could find this thing going through this low, right, from just a week and a half ago, and it was at spike bottom, right? We're right there at that low, right? And then you got to actually say to yourself, okay, so here's another spike low that we had. That was like 164. We're not that far away from that. And then it brings you down to 154. And to Carter's point about the SPY, it can be perfectly healthy, just taking off a little bit of that froth, that sort of thing. And we know that this name is actually prone to some headline stuff as it relates to their ability to sell these H20s to China or so. So thoughts on Nvidia, because we're looking at it again, because it's still the largest market cap company in the world.
Yeah, I think it's look. I think I've been clear. We talked about the quarter. We talked about the expectations in the quarter. I know how excited people got on the back of the quarter. I will tell you, I didn't think the price action was particularly good. What we've said is we've seen this a couple times before with Nvidia. For everybody out there that thinks it just goes straight up, it doesn't. We've had some pretty significant peak to trough declines, and I'll be consistent. I think we're on the precipice of the same type of thing. I think the number you outlined is the right first level, that 153 and change, which was the prior high back in January. And you recall what happened on the back of that. And then we'll see what happens if and when. Ultimately, I think this thing has sort of 120-ish written all over it. I think what's going to happen along the way is we're going to work off this quasi oversold condition in the RSI. So some sideways to slightly higher days will work that off. But I think this is headed to those levels, and people say, how can you say that? Well, I just said it, number one. And number two, it's not like we haven't seen it before. I know there's a lot of rhetoric around it in terms of the stock has been so good, but people have really short memories. That move that we saw, Dan, from 153, whatever the April low was, I think it actually had an $80-something handle on it. You can say that you were sitting in the pocket and waiting. I am here to tell you that probably scared the shit out of most people that it endeavored into the name, and I think we're on sort of the doorstep of seeing a similar type of move.
Yeah, and one of the things that I find interesting is that this notion that the retail investor didn't get shaken out in April, which is great. I mean, because one of the things that you and I've seen again and again, to the point you were just making, is that usually retail gets excited, when things are making relative highs. No one knows that they're relative highs, that sort of thing, and they get really disappointed and just kind of throw the baby with the bathwater on what might be relative lows. And it seems like that's not the case, or at least it hasn't been the case on this year. And like people talk all the time about institutions and the sort of risk management that they have. The truth is, most long short equity, funds now, they do run very close nets, meaning like they don't have a ton of net exposure, long or short. So their ability to hang on to some of their most, confident sort of, situations or names, that sort of thing, is kind of better usually than that of retail. Retail are generally not hedged up, that sort of thing. So it will be interesting to see, Guy, after such a massive run, off of those April lows as the narrative has shifted. You've been making this point. The percentage of the beats are getting smaller and smaller, right? It's harder for them because they're lapping some huge numbers on a calendar basis, you know what I mean, that sort of thing. And you say to yourself, with all this unclarity about their ability to sell into China, and it's not just the VIG they have to pay our government if they do get the export licenses, but also the Chinese are now saying to their local, buyers of these sorts of GPUs that they shouldn't be buying them. So this is going to be, I think this is going to turn into a battleground stock. And it really hasn't, other than folks, let's say like me or something like that, who've been trying to point out how this trade could go wrong. And in the face of the sort of move like we've had, make no mistake about it, this is an unnatural move off the April lows to gain $1.5 trillion or maybe more, you know what I mean, based on the hope that they're going to be able to sell to China, that the data center builds around the world can continue to go at the pace they are, and the CapEx from these hyperscalers is going to continue. To me, that seems pretty toppy right here, right now, guys.
I agree. And again, there's been a level of consistency there. It hasn't felt good more than a few times in terms of trying to be that voice. And obviously, when the stock goes up, I think the contra voices sort of get drowned out. But it doesn't mean the things we've been concerned about are still not manifesting themselves. Real quick, Wavy McFly, gold miners. We talked about the GDX Wavy, so thank you for that question. Matt Walter asked if Carter had thoughts gold versus silver versus Bitcoin. I think we had the gold chart, so I think it's pretty clear what he thinks. I don't know his thoughts on silver. I can speak, though, and say that very quietly, silver's had a tremendous move, and we've actually highlighted that one. But this is sort of one for you, Dan. This is from Peter Gestland. I hope I pronounced that right. My largest short is Coreweave, a 75.50 October-December calendar put spread. Do you have a downside target? So that's working out for him so far, it looks like, because I think Coreweave's about $93. And, if I'm looking at it, do I have a downside target? I don't, because it's, newly traded stock, but it feels a little dicey here to me.
Yeah, let's pull up the legend here again, because I think there's some interesting stuff, Peter, on the chart here. Okay, so let me just go to year to date so you can see. Okay, well, we don't need to do that. Let's just say, okay. So when I look at this and I say to myself, all right, this goes public in late March, it has that huge, kind of 2-day move, and then it gives it all back. It goes right back towards, you see where my cursor is? The price. I think it actually broke price guy briefly at $58 or something. And then it becomes a meme stock. Okay. Like make no mistake, that's meme action, right? And we saw a bit of that in look where it bottomed out, right? In early April. This is a couple weeks after the thing went public, and look at how it's just kind of come in fairly orderly. You did have that little bounce. It got kind of slammed as we were getting some of the earnings in and around, some of these hyperscalers and the like. I think it probably breaks this $82.50 level. And then I really do believe that next level is down there at 64. I think there's an air pocket between, let's call it 84 and 64. And for a stock like this, that's going to have lockups, that's going to have a lot of, back and forth over these different CapEx. What does the capacity look like? What is the demand for this sort of compute? So to me, this is subject to what the major hyperscalers have to say. Microsoft, when they went public, was like 70% of their revenues. So this is going to be very tied to those big names, guys.
Last one before we get out, and that was well done, by the way. Jack CF, which is better by UPS or FedEx? Well, they both suck, Jack, I think, as you know, but look at look at UPS real quick. It's trading 85 and change. I want to say we're right at the 52-week low. I might be off, but we're approaching levels that we probably saw in March of 20, and I think we all remember March of 2020. And Dan can sort of extend that out and take a look. So if you've been waiting, you're getting close to levels that you got to even go farther than that. You haven't seen in quite some time. So there you go. So you tell me, Dan, if it gets there. I think if it gets there, maybe you sort of do the eyes closed thing. But man, oh man, they both really suck. And UPS has been mostly, well, they both have the same types of problems. I think each one of them then specifically has their own problems. UPS seems to sort of be doing worse than FedEx, but both have been shitty. But to answer the question, I think UPS against that prior low could be interesting.
Yeah, and for those of you who ask, how is a stock like this down this much, right? So the stock traded, I'm just looking at this right high, a high of what, got 210 or something like that, and here we are down at $85, right? Well, here's one way you get that way. In 2022, okay, this is prior to the stock. Well, right around at the time is making its all-time high, guy. They did $13 basically in earnings, okay, and on revenue of $100 billion. So this year they're expected to do $87 billion in sales, and their earnings have been cut in half. So if you think about that, their sales have gone down $13 billion, but their earnings have been cut in half. So there's something going on with this business, the way they're either executing, the way pricing has gone, and that could be a competitive sort of thing. I mean, there's a whole host of things, but that stock chart tells the story. It's a very orderly upper left, bottom right. The problem is, look at these gaps. I'm just going to, like gap after gap after gap. So they're basically either have very poor visibility into their own business, very poor visibility into the macro, right? Like there's a whole host of other things going on here. But at some point, do they get their act together? Hey, listen, I wouldn't be surprised, guy. And there was a great daily podcast today with Andrew Ross Sorkin, who is obviously of Deal Book fame, but also on the Squawk and Friends on CNBC from 7 a.m. 6 a.m. to 10 a.m. 9 a.m. Excuse me. And he was being interviewed by his New York Times colleague, and they were talking about these unprecedented investments by the Trump administration, whether it was MP from the Defense Department, whether it was Intel, them getting a stake for the jobs or the CHIPS Act money or this and whatever. I wouldn't be surprised if you're going to look and see some of these things in what they might seem to think are important strategically. You don't even, maybe UPS falls into that category. I think one thing's important to remember, though, is like if the government's taking these stakes so these companies can continue to operate. Listen, UPS isn't going out of business. Okay. Like that's not that's not the thing, but those are dilutive share sales. You know what I mean? Like, so it doesn't make a lot of sense to me to want to be an equity holder when the government's basically getting free shares. You know what I mean? Like, especially in the Intel situation where they're already going to get that money one way or another,
So we've talked about that, and there's another one coming. I don't know what it is. I mean, Lockheed Martin's been thrown out there. I think you're right to bring up UPS or FedEx, and once you sort of go down that road, I do think it's a slippery slope. That's me. But there's an inevitability to all this, and the stock market didn't seem to care the first foray with Intel. I think if there are a few more of these things, I think not only will the stock market care, but more importantly, the bond market's going to start to care. And to a certain extent, that there could be one of the many reasons that global yields continue to go higher. I mean, all these things are somewhat interconnected, but we've expended our time for today.
Yeah. The last thing I'll just say on the yield front, guy, because you just brought it up. I mean, the 10-year, this 4.2 level, we've been talking about it. You look at Carter's charts, and it's hard not to see the series of lower highs, right? And then we're up against that, that 4.2 level, which is support. Okay. Like, to me, that looks bearish. I'm just, you know what I mean? Like, and again, that's just a judgment.
No, yeah, you think yields are going down. When you say bearish, you think that's going to break that uptrend.
Yeah,
line.
I mean, that's just a technical, what do I know? It could go back up right towards that, that downtrend, line, and who knows what the hell's going on. The 30-year, though, definitely looks like it wants to party a little bit. And I think that's what you've been kind of suggesting, is that on the shorter end, whatever the Fed's going to do, have a ball. We have no idea what the 10-year is going to do, what the 2-year, should go down with it. We don't know what the 10-year is going to do. But right now, the 30-year has given us a sense that they are worried about debt piles. They are worried about inflation. They are worried about the ability to kind of,
It should be worried.
They look very different. So I just wanted to bring that up on the way out.
Ready to party. I love that. Well, we have, I think tomorrow's Wednesday.
Yeah.
And Liz is now on third. I don't even know. You have it all written down. But we have Rebecca Patterson this week on
that's Thursday for Friday drop. We do have Liz on. We have Peter on. You and I are going to have a great conversation today. Very different than what you and I talked about. We have some things that's already teed up for the Risk Reversal podcast that will drop on tomorrow morning. So thanks for being here, folks. We'll see you tomorrow morning at 11 a.m. Check out the Risk Reversal podcast. It's going to be in your feed when you wake up. Thanks. Bye.